Okay, so now let's get started with what happens when the central bank exercises its third monetary policy tool, which is of, say, for example, increasing the required reserves ratio (RR). Okay, what you see here is essentially the same setup where you have total reserves on the x-axis, the interbank rate on the y-axis, and at the moment, before the increase in RR, the equilibrium was at IR1. Okay. Now, when the central bank conducts this exercise of increasing the required reserves ratio, you essentially see that the demand curve of reserves shifts to the right. Now, why does that happen? As we saw earlier, the demand for reserves in the banking system is obviously influenced by the required reserves ratio, right? And if the central bank increases the required reserves ratio, say from 10% to 20%, then R1D shifts to the right to R2D, while nothing really changes on the supply side, right? The central bank is not really doing any open market operations, hence the non-borrowed reserves aren't really increasing. So the supply curve remains as is, but the demand curve shifts to the right. What implication does that have to the interbank rate? Well, it increases to IR2. And it's quite intuitive as well, isn't it? Because if suddenly the required reserves ratio is doubled from 10% to 12% to 20%, then all the banks would want to satisfy that requirement by borrowing from each other in the interbank rate. And since the demand of reserves, excess reserves, would increase so much, banks would start to charge more for lending overnight. And that will essentially increase the required reserve, the interbank rate. Okay, so that's one way of increasing the interbank rate or decreasing the interbank rate. Say, for example, if the central bank reduces the required reserves ratio, then that would have the opposite effect and it will decrease the interbank rate. Now, as I said earlier, this was a very popular tool a few decades back, but is not so much anymore. Okay. Then, when we discuss the effect of the no yeah, so now we are basically addressing what happens if the central bank increases the interest on reserves, okay, which is the floor of this of the interbank rates, IOR. And pretty much analogous to the case of what happens if the central bank decreases deposit rates out here that I discussed some time back. It's quite straightforward to see if the central bank increases the interest on reserves, it's not going to have much of a difference, as you can see, simply because even after the revision, if the revised interest on reserves are still lower than the interbank rate, it won't really change the interbank rate. Okay, you have a new demand curve now, R2D, and the interest on reserves are a bit higher, but still it doesn't really affect either the total amount of reserves in the banking system, nor does it affect what the interbank rate is, IR star. But again, it's quite important to understand that it's quite important to understand under what circumstances can the central bank actually increase the interbank rate by increasing the interest on reserves, IOR. And first of all, it's quite important to see when does that happen. And again, the answer is quite analogous to the case where we discussed the case of decreasing the discount rate. And in this case, when the interest on reserves, so if I go back to the previous slide, if the interest on reserves is actually equal to the interbank rate to begin with, okay, that is the supply curve intersects the demand curve on the flat section of the demand curve, that's when if you increase the interbank rates, sorry, not, that is when if you increase the interest on reserves, it will also, automatically shift the interest on the interbank rates as well, okay? Why is that? Because again, of the same principle, if interest on reserves are equal to the interbank rate and the central bank increases the interest on reserves, then any bank would either happily lend to a different bank by who's agreeing to pay as much as the new interest on reserves, or if not, then this commercial bank will simply deposit the money in the deposit facility of the central bank and earn at least as much as the interest on reserves. Okay, so that's the idea, that the central bank can in fact influence interbank rates in specific cases. Now, analogous to that is also the question of how does this show the usefulness of this tool vis-a-vis open market operations. Okay, and a hint is obviously what I gave earlier as well, that if you are now normalizing the monetary policy after having many years of quantitative easing, increasing the interbank market rate is far easily achieved by increasing the interest on reserves than by conducting open market operations. Because just imagine, if you have to increase the interbank rate by conducting open market operations, the central bank has to then reverse everything that it did over the years, right? It has to conduct in huge asset sales for many months or years to come, and that's a long and painful process. And if the central bank wants to increase the interbank rate now, then this interest on reserves is a very useful tool. Okay. So that essentially is a broad overview of what the supply and demand for reserves look like, and how can a central bank exercise control in the interbank market by the four tools. Okay, the first is the open market operations. The second would be changing the minimum required reserves ratio. The third would be discount rate. The fourth would be the interest on reserves. So there are four key tools with which the central bank can influence the interbank market. And out of the four tools, the most important one is the open market operations. Now let us get to the idea of a monetary operating instrument. Okay, the first thing that we discussed was tools. Now we're talking about instrument. And what is an instrument? Well, a policy instrument or an operating instrument is a variable that responds to the central bank's tools and indicates the stance of monetary policy, whether the monetary policy is easy or tight. Okay, you want a kind of a instrument that obviously responds to what what tools central banks have, and obviously it should properly indicate whether the central bank is trying to achieve a tight monetary policy or an easy monetary policy. Now, the first kind of operating instrument is the reserve aggregate, right? It's quite straightforward to understand why. Because, and reserve aggregates include total reserves, non-borrowed reserves. It can be monetary base. It can be that the central bank is focusing only on maintaining a specific level of non-borrowed base. And this is all about controlling the quantity of reserve aggregate. Okay, so in the previous slide, for example, the central bank can be focused on achieving a specific amount of Rn. It can be, I don't know, $800 billion. It can be $2,000 billion, whatever it is. It can be the case that the central bank is just focused on ensuring that the banking system has at least this much amount of reserves, not more than that and not less than that. Okay, something like that. And it's quite important to note that if the central bank is having a reserve aggregate as the operating instrument, then the central bank cannot control the interbank rate. Okay, you cannot achieve a stable interbank rate if your objective is to stabilize a monetary aggregate like the non-borrowed reserve or the non-borrowed base. Okay, interest rate is a secondary instrument, okay, or nominal exchange rate, but I won't be covering nominal exchange rate. Maybe that will be covered in international finance unit that you may take next semester. But right now, let's just focus on the second monetary instrument, which is interest rates, which is the interbank rate, that is. And in this case, what you're doing is you're fixing or targeting a particular level of interest or price, okay? And to achieve that particular level of interest or price, the price is essentially on borrowing, right? So if you're having a specific interbank rate in mind, you're essentially fixing it by changing the quantity of the reserve aggregate. And that can obviously be adjusted through open market operations. And it's quite important to understand that interest rate is in fact the prevalent instrument for most advanced economies. Most central banks in advanced economies do in fact follow or target interest rates as their key monetary operating instrument. The example is obviously the US, for example, which focuses on the federal funds rate since the 1990s. So let me give you a bit of idea on what I just said in graphical intuition. This is the case where you're targeting non-borrowed reserves, okay? And what's happening is that even if RD is the key curve of the key demand curve of reserves, it's very much possible that there are fluctuations in that demand curve, okay? Because there are fluctuations within and out of currency, correct? And if there are fluctuations from currency to deposits and deposits to currency, automatically the demand of reserves would change as well, right? So for example, if I'm a bank, I'm a commercial bank, I hold $100 of deposits, and suddenly somebody comes and takes $50 out, which now becomes currency in circulation, then automatically my need to hold reserves go down as well. Because if earlier I was supposed to hold $10, assuming a required reserve ratio of 10%, now I'm only required to hold $5. So my demand curve would shift to the left in that case. And consequently, or vice versa, if I receive some deposits, then I have to maintain some level of reserves, and consequently my level of my demand for reserves would go up. So the idea here is that if the demand curve is shifting left or right, which it may in reality, if in case the central bank is targeting non-borrowed reserves, then it will ensure that the supply doesn't really change. That's a very simple way of ensuring a particular level of reserves, because ultimately the central bank is a monopoly supplier of reserves and currency. So if it doesn't change that, ultimately in the economy as a whole, in the banking system as a whole, the total number of reserves would stay the same. And the central bank doesn't really have to do anything in this case. The objective is automatically achieved. But what it does is that if, for example, the demand curve shifts to the left, then you have an interest rate IR2, which is lower than IR star. And if in case the demand curve increases, shifts to the right, then you have a new interbank rate, which is IR1, which is greater than IR star again. So as you can see, if the central bank is focusing on a reserve aggregate, okay, as an instrument, by necessity, it won't be able to target interest rates, okay, the interbank rate. They will fluctuate. In fact, the central bank will have to allow the interbank rate to fluctuate in order to actually ensure that the demand meets the supply for the reserves. Now, what happens if, on the other hand, the central bank is not really targeting a reserve aggregate, but is actually targeting this interest rate IR star? It's more keen on keeping IR star as a monetary operating instrument. In that case, assume the same thing happening, right? Assume fluctuations on the left and right hand side of the demand curve. In this case, what the central bank would do is that it will either reduce the supply of reserves or increase the supply of reserves in order to meet the target interest rate, the interbank rate of IR star. Okay, so assume that the demand for reserves have gone down, which the demand curve shifts to the left. In that case, what will happen is that the central bank will conduct open market sales, okay, and that will essentially reduce the amount of reserves in the central bank in the banking system, and it will shift the total number of reserves to Rn2, but it'll keep the interest rate, the interbank rate, constant at IR star. Now, what happens if the demand curve shifts to the right? Again, what the central bank would do is that it will conduct open market purchases, consequently inject more reserves in the banking system, and hence again ensure that the interest, the interbank interest, is again back to IR star. What happens if the central bank does not do this? If the central bank does not do this, what will happen is that the interbank rate would again go up, as I just showed you in the last slide. So in order to ensure that the interbank rate doesn't start climbing up, the central bank will basically inject more reserves in the banking system. So that essentially is what it shows, that if you're targeting interest rates, that is IR star, you will have to allow fluctuations in the monetary aggregate, which in this case is the non-borrowed reserves. Okay. On the other hand, as I showed you in the last slide, if you're focusing on a monetary aggregate like the non-borrowed reserves, you will have to, by necessity, allow fluctuations in the interbank rate, okay, for the demand and the supply curve to clear. I think it's important to, when you're going through the background reading, you will understand why central banks around the world have adopted interest rates as the preferred monetary policy instrument. And that's because when you're choosing a policy instrument, it has to satisfy a few criteria, right? The first, obviously, is the fact that it should be easy to control. The second is that it should very clearly indicate the stance of the monetary policy, whether it's lax or it's very tight. The third, obviously, is its intended effects on the economy, right? And it's very important to compare all these three aspects to understand what finally is chosen as the policy instrument. In the case of interest rates, they usually satisfy all these criteria quite well. Obviously, when the central bank, after its monetary policy committee meeting, comes out and says, we are targeting interest rates in the range of 1.25 to 1.5, it gives a very clear message to the whole economy of what is the level of monetary policy, whether it's tightening up or whether it's playing it more easy, whether it's a more accommodative monetary policy. So I think these are the few concerns that every central bank has to evaluate before choosing what kind of monetary policy operating instrument you want to go for. And just before ending, I think it's quite important to see how this monetary policy looks in practice. Now, I've taken these graphs from the Federal Reserve Bank in the US, and essentially the graph on the top shows the effective federal funds rate, which is basically the interbank rate, in blue, and it shows the upper bound and the lower bound that the Fed announces what's the lower range or the lower limit of the FFR, or what's the higher rate or higher limit of the federal funds rate. Okay. And as you can see, following from 2016 onwards, the Federal Reserve has been consistently tightening the monetary policy, right? Which you all may have been aware of. But what is very interesting to see is the graph below. And that essentially shows the interest on excess reserves and the effective federal funds rate. And you can see you can see it matches exactly the graph above. As the Fed increased the interest on excess reserves, that also kind of pushed the effective federal funds rate. And it's quite important to see that in this case, as I said earlier in the lecture, the Fed is actually pushing up the interbank rate through the tool of interest on excess reserves. Okay, it's obviously slowing down and reversing the process of quantitative easing, but to increase interbank rates when it wants, it has in fact used the tool of interest rate on excess reserves, as you can see. Now, the only surprise that some of you may have if you compare my graphs from the earlier lecture or from a few slides before, what you will find is that the effective federal funds rate is actually lower than the interest on excess reserves. And that is kind of puzzling, because at least theoretically we showed that the interest on excess reserves kind of gives a lower bound or floor to the federal funds rate or the interbank rate. In this case, it's quite not what the theory says. So that kind of leads us to our final and third question of this lecture, which is, why is the Fed funds rate lower than interest on excess reserves? And a hint to that is obviously the central bank can very clearly control what the interest on excess reserves is. That's in its control. While what is not in a complete control of Fed is what the interbank rate is going to be. Okay, and the rest of the answer I'll leave it on you to probably extract somewhere from the internet to see what explains that the interest on reserves is actually slightly higher than the federal funds rate. Okay, so that is where we end this lecture, and see you next week.